How do you save money on taxes when you are a wealthy business owner or a high compensated business owner, high compensated executive that owns a company, and you're limited on your 401k contributions and your profit sharing contributions? How do you put more money into tax-free, tax-deferred, tax-free investments like a Roth IRA when you're phased out on how much money you make? If you want to know how to maximize your tax efficiency and minimize your tax liability, watch this video. For those of you that haven't been here before, like, comment, share, subscribe is what I want you to do. Let's dive into the conversation. Send me comments. Check out the description to set up a 15-minute phone call with me where we can talk about this a little bit further. Let's set up a phone call with your tax advisors, your CPA, maybe even your financial advisor to help them implement this for you. So this mountain of tax efficiency is not originally mine. I was allowed to use this by a good friend of mine, Pete. So if you're watching this, Pete, thank you. I've kind of changed it up a little bit, but the concepts are still the same. So everyone's familiar with qualified plans, 401ks, defined benefit, profit sharing plans. And those are really good because they allow you to put money on a pre-tax basis and they grow tax deferred. The challenge is that they also, when you start taking distributions out, they're heavily taxed, fully taxed as ordinary income. So the government's not dumb. Anytime the government allows us to do something is because they think they're going to benefit from it more in the long term than what we are. And so think about seeds versus harvest. When you put money into a qualified plan, you're putting in dollars today that are seeds. And when it grows tax deferred, that harvest gets bigger, or that product gets bigger. And by the time it's time to pull money out, you're harvesting and they're going to tax you on the full amount of the harvest. So the question is, are you going to be in a higher tax bracket in retirement or a lower tax bracket in retirement? That's a whole nother video that we did. You can check that one out. And then you've got other types of plans, non-qualified deferred compensation plans like supplemental executive retirement plans, otherwise known as SERPs, 409A plans, traditional deferred comp plans. You've got plans called cash balance plans. There really is a balance of how much goes on a pre-tax basis. But for a highly compensated individual, you have challenges because if you just did your 401k and profit share, your max contribution right now is about $70,000 on a pre-tax basis. When you implement some of these 409A plans or deferred comp plans called cash balance plans, did you know that you could put in hundreds of thousands of dollars on a pre-tax basis? So that's good today. That helps you out today, but it also creates a challenge when it comes time to take those distributions out. But there are strategies on how to minimize the liability of the withdrawal taxes if we set it up properly from the beginning. So make sure you reach out to us to talk about how to do that. And then you've got other types of specialized plans with pre-tax funding and then partial taxes on the withdrawals, like charitable remainder trusts, gift annuities, pooled income funds, captive insurance companies. And all of these are scrutinized and looked at by the IRS because, let's face it, people have tried to bastardize these types of plans. And what we're talking about here is legal tax avoidance, right? Using the black letter law of the IRS. What we're not talking about is tax evasion, which gets you prison time and back taxes and penalties and fees. So this is not evasion. This is legal tax avoidance using the black letter law of the IRS. And so if you are a high income earner and you have a significant net worth and you have not heard about charitable remainder trust, gift annuities, pooled income funds, captive insurance companies, hit me up in the description section. Let's set up a 15-minute phone call to talk about that. And then you have even more specialized plans using tax efficient funding and tax-free withdrawals. They're called super charitable lead annuity trust, section 162 plans for executives. And then at the very top of the mountain, you have tax efficient lifetime income solutions, premium finance life insurance, self-finance life insurance, charitable LLCs when done properly. And all of this, the caveat is when done properly, legally and ethically within the IRS guidelines. And then you have family retirement account. So what you want to figure out is the balance between making a ton of money today, and I want to defer as much income tax as I can today so I don't have to pay the full tax bill. But what liability does that create in the future? What can we do to minimize those potential income taxes in the future? We can look at pre-tax pension planning. We can look at charitable giving. Let me ask you a question. Why do you think high income earners, celebrities, athletes, and some of the highest compensated people that you can think of in the world. Why do you think that they're so quote unquote philanthropic? Do you think it's because they have a good heart and they're genuinely wanting to help out all these people that don't have money? Maybe a portion of that is true, but the lion's share of the reason why they create these foundations, they're so philanthropic, they're so charitably inclined, is because the federal government gives you tax incentives to do that. You can save 40, 50, 60 cents on the dollar from a tax perspective by being charitably inclined. And you can create donor advised funds, you can create family foundations, you can create all of these different types of charitable structures that allow you to, yes, you're going to help people, you're going to help organizations that absolutely need to help, but you're also going to be able to help yourself in the process. So qualified pension planning using something like a cash balance plan, mixing in a component of some type of charitable LLC or family foundation or donor advised fund, and then creating some type of estate tax plan or tax-free distribution plan using permanent life insurance, premium finance life insurance, Section 162 plans. And when you put all of those things together that have to be customized and bespoke to your situation, you are doing everything within the black letter law of the IRS, but you're maximizing pre-tax contributions today, tax-deferred growth while the money is growing, and tax-exempt, tax-free, tax preferential distributions on the backside. So that's how you climb the mountain, and that's how you descend the mountain. And as an aside, when you think about mountains, Mount Everest comes to mind. Do you know where the majority of the deaths occur from somebody climbing Mount Everest? You would think it's on going up the mountain, right? But that's not where the majority of the deaths are. And I think last year there was a statistic out there. I forget the statistic, but the majority of the deaths occur on the descent. Don't let that happen to you in the mountain of tax efficiency from a retirement perspective. Don't die on the descent because you're paying too much in taxes. Like, comment, share, subscribe, reach out to me. Let's set up a call. The link's in the bio, 15-minute call with John. Talk to you soon.